Welcome to Bank Director's online training series and the unit on the Bank Secrecy Act. My name is Alan Abel, and I'm the Global Anti-Money Laundering Services Practice Leader for the accounting and professional services firm of Crowe Horwath LLP. This is the online training series' second video on the Bank Secrecy Act and related anti-money laundering regulations and regulatory expectations. In the first video, we provided a broad overview of the various requirements that have been spelled out by law. We discussed why AML enforcement by the bank regulatory agencies has taken on such heightened importance in recent years. And we offered a few sound and leading practices that bank boards should consider when it comes to their governance responsibilities in this important compliance area. In this video, I would like to cover the most crucial elements of a sound BSA AML compliance program and also delve more deeply into the responsibilities of the board in terms of ensuring that their bank has an effective enterprise-wide program in place. Of all the regulatory mandates and expectations that banks must comply with, few are more complex or more demanding than the Bank Secrecy Act and related AML requirements that have been implemented over the years. This creates a challenge for directors who must have a sufficient understanding of some fairly technical issues in order to provide effective oversight. Before we get into the specifics, let's take a moment to review some important background that will help put the rest of my remarks in their proper perspective. The original Bank Secrecy Act dates back to 1970 and has been amended more than 100 times through the passage of additional and amended laws, including and especially Title III of the USA Patriot Act, which was enacted in 2001 after the 9/11 terrorist attacks. The Bank Secrecy Act requires that financial institutions protect themselves, our financial system, and assist the U.S. government in detecting and preventing money laundering and related financial crime by reporting unusual and suspicious activity and recording and reporting specific types of other transaction activity. Bank Secrecy Act enforcement has been a top priority for the U.S. government and the federal banking agencies for quite some time. I would say demonstrably since 1986, with the first Federal Reserve BSA enforcement action and a fine against the U.S. bank, and it has become even more so in recent years as a result of heightened congressional scrutiny. Banks are required to have in place an enterprise-wide BSA AML compliance program with strong controls. The Bank Secrecy Act is administered and enforced by the Financial Crimes Enforcement Network, or FinCEN, which is an arm of the Treasury Department. FinCEN has the power to issue enforcement actions and fine banks for BSA violations. The Justice Department can also assess fines for violations, and it can press criminal charges against a bank for significant violations. The federal bank regulators are responsible for the implementation of their BSA regulations and also for examining banks to determine whether they are in compliance. These agencies also have the authority to make enforcement actions and to fine banks for violations and to enter into consent orders for program remediation as they deem necessary. The consequences of BSA violations can go beyond civil and criminal charges and fines. If the regulators find significant shortcomings in your bank's BSA AML compliance program, they could also bar you from pursuing other important strategic actions, like an acquisition or entry into a new marketplace, until the problems have been corrected. And program remediation can be quite an extensive and expensive undertaking and can take a long time not just to complete, but to test completion. The point here is that BSA AML is not just about compliance risk. It is also very much about operational, strategic, and reputational risk. Now let's talk about some of the key elements of a comprehensive enterprise-wide BSA program. There are 8 critical areas that I would like to focus on, and they are: empowered comprehensive enterprise-wide program with strong controls, human resources, know your customer, customer identification and due diligence, monitoring and reporting, enterprise-wide AML risk assessment, training and awareness, independent testing, and the roles of senior management and the board. Bank regulators expect that BSA AML compliance programs will be enterprise-wide, not just designed for and operating in major business units. They expect that the compliance programs apply not just at the bank level, but also the holding company level, to all subsidiaries, and even outsourced processes. And where those processes and activities are outsourced, the contracts and service agreements in place must clearly specify roles and responsibilities. Banks can outsource certain AML processes, but may not directly or inadvertently outsource their responsibility, just like any other area of compliance. Implementing regulators require that boards of directors formally appoint an individual to be responsible for directing the bank's BSA AML compliance program and for monitoring day-to-day compliance. The ordained BSA officer has many responsibilities, frequently including overseeing customer activity monitoring and monitoring the event horizon for news, timely and accurate filing of required reports, management reporting, and handling of AML training for the bank's employees, officers, and directors. The BSA officer usually has the responsibility of acting as a liaison with the bank's regulators, law enforcement, and other banks. The professional background of this individual can vary and might include compliance, auditing, and operational experience. They frequently have professional certifications like CAMS, Certified Anti-Money Laundering Specialists, CFE, Certified Fraud Examiners, CPA, or other compliance certifications. They also need to understand the bank and its business and be capable of running a large enterprise and administering a complex set of policies with a very wide lens, where the consequences of underperformance could be significant to the bank. Frequently, the BSA officer will report to the bank's chief risk officer, chief compliance officer, or general counsel, although it's also important that they have a dotted line reporting relationship with the board. The regulators expect that the BSA officer will have access to the board as needed, and it is vital that they have visibility within the organization so that the importance of their role is understood by all employees. The BSA officer needs to be sufficiently empowered to be effective in their role. All BSA implementing regulators expect banks to take steps to identify their customers and determine that they are who they say they are. Information that banks must collect or generate when a new customer opens an account includes their name, date of birth, address, and a taxpayer identification number. Banks must also take steps to verify the new account holder's identity and match their name against a database of known or suspected terrorists and terror organizations. This is also a requirement of the USA Patriot Act and the Office of Foreign Assets Control, or OFAC, also a Treasury agency. Through a process referred to as customer due diligence, the regulators also require that banks take steps to verify the new account holder's identity and assess the level of risk that the customer could pose to the bank. High-risk customers may be subject to enhanced due diligence, where even more information is sought and verified, including such things as the account holder's occupation and/or the nature of their business, the purpose of the account, the expected activity associated with the account, and sources and expected uses of funds. The ultimate purpose is to help banks identify suspicious activity when it occurs. The most important BSA requirement is that banks monitor for unusual and suspicious activity and report this to the federal government in a highly informative and secure manner. The BSA provides banks a safe harbor for reporting suspicious activity. Also, banks are required to continue to track and report suspicious activity for as long as the activity continues if law enforcement asks the bank to agree to keep the account open to assist in an investigation. When the monitoring process identifies activity that seems to have no business or lawful purpose, banks are required to file a Suspicious Activity Report, or SAR, with FinCEN. Today, AML technology is used by most banks to monitor for unusual and suspicious activity, and this has rather become a universal regulatory expectation. In addition, banks are increasingly using newer AML compliance-enabling technology to perform an enterprise-wide AML risk assessment similar to other compliance risk assessments. Technology is also used to risk-rate customers during the onboarding process through the use of dynamic questioning and in the validation and tuning of monitoring systems. While regulators have evolved growing expectations for the effectiveness of BSA/AML compliance processes and controls, banks are increasingly looking for ways to do so more efficiently in order to curtail the rapidly mounting costs connected with accreting layers of compliance. For example, banks are seeking newer total workflow solutions for analyzing alerts, investigating cases, producing adequate audit trails of work and decision support, and standardizing repeatable processes surrounding high-volume compliance events. It is also required that your bank conduct an enterprise-wide AML risk assessment to assess and identify its potential money laundering and terror financing exposures. A business line risk assessment should identify each business unit's vulnerability to money laundering and related financial crime, and will focus on its customer risk, products, and geographies, as well as policies, procedures, and systems, and other controls that are in place to protect the bank, its employees, officers, and directors from being penetrated. All business units and support areas of consequence should be included in the enterprise-wide risk assessment, and the assessment should be done at least annually or as frequently as significant changes occur. The AML risk assessment process should be sustainable and subject to preemptive and proactive continuous improvement. An enterprise-wide risk assessment will take a more holistic view of the bank's customers, products, and services, and geographies to determine whether there are specific money laundering and terror financing exposures that might not be apparent at the business line level, but become more visible when the risks of the business unit exposures are aggregated across the entire bank, the entire customer relationship, across business units, and geographies. For a large institution, especially operating in multiple jurisdictions, this can be quite the challenge. If your bank has implemented an enterprise risk management structure for the entire institution, this will be a familiar concept. Another focus is on the level of exposure emanating from the bank's customer base, and is arrived at through a risk assessment of each new customer performed at the start of the relationship based on information that the customer provides when opening an account for both individuals and businesses. Customer risk assessments are important in establishing a baseline profile of expected activity, and bank financial investigation units, or FIUs, are expected to have processes and controls in place to flag transactions that significantly vary from this profile and deserve an explanation. Ongoing training is an important component of any AML compliance program, not only because it's required by the Bank Secrecy Act, but also because both the regulations and the underlying activity of money laundering and terror financing change with such frequency that BSA staff, senior management, and the board have to stay abreast of it. Not all bank training and awareness programs will look the same, but should be tailored to the individual institution's business environment, and the event horizon, customers, geographies, products, risk appetite and assessed risk, and strategy going forward. Areas that most training programs would cover include an overview of key BSA/AML regulatory requirements and expectations, as well as any significant rule changes, new trends in money laundering or terrorist financing activity, a review of the bank's policies and procedures, and emerging sound and leading practices in compliance. Business unit employees who interact on a regular basis with customers, open customer accounts, or process transactions should participate in AML training, along with the bank's compliance and internal audit staff. Training should also be required of any third-party service providers whose activities fall within the scope of BSA compliance. An important pillar of sound BSA compliance is an independent, risk-based test of the entire program, emphasizing the 8 critical areas that I outlined at the beginning of the video. BSA regulators expect that every bank's BSA/AML compliance program undergo independent testing every 12 to 18 months. This testing process must be conducted by individuals who are independent of the program, and it is expected, although not required, that the independent tester will be an auditor. The independent test checks to see whether the program is in compliance with regulatory requirements, procedures, and controls. Specific areas that independent tests will examine include the role of the board and senior management, the methodologies used to perform the various required risk assessments, transaction monitoring, record keeping and reporting, training, AML policies and procedures, and the use of technology. There are significant roles for both the board and management in AML compliance. Senior management is responsible for implementing the bank's program, communicating the importance of AML compliance to the bank's employees, and making sure that the AML compliance team has the support and cooperation of all business units and support areas of consequence. It is also the responsibility of management to provide the board with regular reports that summarize the program's performance, strategic initiatives, for example, implementing a new monitoring or workflow management system, and identifies any emerging risks that directors should be aware of. Given the large amount of material that directors are expected to read through in advance of board meetings, it is important that the reports highlight what they need to know about the bank's BSA risks and provide useful information rather than burying them under a mountain of data. Although the board does not have any operational responsibilities when it comes to AML compliance, its role is just as important. The board is expected to establish the bank's risk appetite, and this responsibility applies to BSA compliance just as it does universally throughout the bank. It is not an exaggeration to say that behind every strong program stands an engaged board that understands the importance of compliance, especially in light of the potentially severe consequences that can result from non-compliance. What is perhaps most important for boards to understand is that the implementing regulators will hold them ultimately responsible for the performance of their BSA programs. As I mentioned at the outset of this video, the board is required to appoint a BSA officer to oversee the program. The board is also required to approve and oversee the BSA AML policy framework. It must establish a clear set of policies for the management of important AML risks and ensure that those policies are being followed. And it is responsible for providing adequate resources to support an effective program. Other important roles for the board are to set high expectations for cooperation and participation throughout the entire organization and to empower the BSA officer. The regulators want to see a culture that encourages compliance, fosters open discussion and information sharing among all those people involved in the compliance process, and seeks to make continuous improvements in the program. Board should consider scheduling regular discussions with senior management and the compliance team to constantly reaffirm the importance of maintaining a strong AML program. The board should, at least annually, review their bank's AML program and policies and seek management's recommendations on any changes that should be made. And if a deficiency is uncovered in the bank's program or processes, whether by the regulators or the bank itself, it is the board's responsibility to see that the problems are fixed as quickly as possible. It is not enough to simply issue a mandate to management that the problems be fixed. The regulators will expect the board to stay engaged throughout the remediation process. To provide effective governance, directors need to have a general understanding of the underlying rules and regulations, as well as the risks posed to their bank based on its customer and product mix and geographical markets. Directors are not responsible for running the program, but they need sufficient knowledge to probe and ask insightful questions. One of the things that makes compliance in this area so challenging is that BSA regulations often change because the underlying criminal activity is changing. For this reason, it's important that senior management and the entire board of directors go through periodic training so they are refreshed on the fundamentals of compliance, understand any new requirements that have come down from the regulators, and are aware of new trends in criminal activity. Board meeting minutes should also indicate that directors have received awareness training. The complexity of BSA compliance can be a heavy burden for boards that are already weighed down with many other critical responsibilities and issues. Typically, most banks delegate board responsibility for AML to one of three committees: a risk committee, a compliance committee, or, in their absence, the audit committee. Placing governance responsibility for AML on an audit committee that is already struggling to stay abreast of a variety of financial audit and risk management issues should be a red flag. If your bank has assigned responsibility for audit and risk management oversight to a single audit committee, you might want to consider establishing a board-level risk committee with AML as one of its core responsibilities. Let me bring this session to a close by summarizing a few key takeaways. The consequences of BSA violations can be severe and can include fines and criminal charges for significant violations. The regulators can also bar you from pursuing other important strategic options, including acquisitions or entry into new markets, until the problems have been corrected. There are 8 key components to every AML compliance program. Empowered, comprehensive, enterprise-wide program with strong controls, staffing, customer identification and due diligence, monitoring and reporting, enterprise-wide AML risk assessment, training and awareness, independent testing, and the roles of senior management and the board. Bank regulators expect that BSA AML compliance programs will be enterprise-wide, not just designed for and operating in major business units. They expect that the compliance programs apply not just at the bank level, but also the holding company level, to all subsidiaries and even outsourced processes. Implementing bank regulators require that the board of directors appoint a BSA officer who is responsible for directing the bank's BSA AML compliance program and monitoring day-to-day compliance. This person needs to understand the bank, be capable of running a large enterprise, and administering a complex set of regulations. It is also important that the BSA officer have a dotted line reporting relationship with the board. All bank BSA implementing regulators expect banks to take steps to identify their customers and determine that they are who they say they are. The bank must also determine what level of risk each customer poses to the bank. The most important BSA requirement is that banks monitor for unusual and suspicious activity and report this to the federal government. When the monitoring process identifies activity that seems to have no business or lawful purpose, banks are required to file a Suspicious Activity Report, or SAR, with FinCEN. It is also required that your bank conduct an enterprise-wide AML risk assessment to assess and identify its potential money laundering and terror financing exposures. The assessment must also occur at the business unit and individual customer level. Ongoing training is an important component of any AML compliance program and is required by regulators. Training programs should be tailored to the individual bank's customer mix, product line, and geographical market. An important pillar of a sound BSA compliance program is independently testing program design and effectiveness in a risk-based manner. There are significant roles for both the board and management to play in BSA compliance. Management is responsible for implementing the program, ensuring that all of the bank's business units provide their full support and cooperation, and providing the board with regular reports that summarize the BSA program's performance. The board's overarching AML role is to set the proper tone at the top, make sure that the bank has all the necessary resources to operate an effective program, and to send a resounding message that protecting the bank, its employees, and our financial system is a top priority. Thanks for joining me for this video on anti-money laundering compliance.